Thanks for joining us today. My name is Steve Seeger, and I'm the Director of Acquisitions and Investor Relations here at SNS Capital Group. I'm joined today by Jared Sturm, CEO and co-founder of SNS. Jared, thanks for joining me today.
Yeah, no, Steve, thanks for putting this on. I really think it's going to be a lot of value to our investors and hopefully help them get to know SNS a little bit better.
Yeah, so the purpose of this video is really just a collection of commonly asked questions that I've put together from our LPs, and we're proactively going to be answering these for you as a resource. So, Jared, would you like to share anything before I jump in here?
No, I just thank the audience for taking the time to get to know us better, and certainly these are our frequently asked questions, and if anybody has additional questions, Steve and I are happy to answer them. These are just the high level ones, so hopefully it gives us the opportunity to start the relationship and then build on it on a more one-on-one basis.
Alrighty, well, I'm going to jump right in here with just an overall intro to the SNS Capital Group team. So, Jared, first question on my list is, what is the track record of our company? How long have you been in the business? How many deals have we done? How many have gone full cycle? I'll let you start chipping away at those.
Yeah, I think our origin story is a little bit unique, so I'll start there. So myself and my brother started the company 16 plus years ago now. But prior to that, we got into the industry as maintenance technicians. So rather than starting at a very large firm and then peeling off to start our own company, we actually started from the ground up. So there's very organic growth and understanding the back end operations of property management, construction, and all the operational components that go in. But our portfolio today, fast forward 16 years, is 1,400 units spread over 19 communities, all in the Cincinnati, Ohio market, and have had a fun journey of building that up, really grassroots, organic.
Awesome. Yeah, and kind of building off of that, what is SNS's basic and just overall strategy? Are we buy and hold, forcing equity, value add, or are we focusing on cash flow? Kind of just touch on each of those.
Yeah, I think the few that you mentioned there, I would say there's some overlap in all of what we pursue, but our business strategy has been quite similar over those 16-year period. So we buy assets that are distressed. We improve that by forcing appreciation, usually through construction and property management or some combination of those two. And then we strip the equity and roll into the next deal. And so the overall investment philosophy is to produce consistent, predictable cash flow, but very often we're seeing a return of capital usually around year 2 or 3 in our long-term hold strategy because we're buying value add and we're forcing that appreciation.
Got it. And could you kind of just dig into a little bit? I know you touched on our overall hold time of our typical assets and our exit strategy. How is the fee structure built up here at SNS?
To the investor?
Yeah.
So our fee structure comes back to an overall philosophy of alignment of interest. So first 8 years of our career, we did not raise money from outside investors. It was all internal capital, forcing that appreciation we talked about, redeploying. So about 8 years into our career, when we made the decision to go into the syndication model, we really were focused on how do we align the interest between our investors and SNS. And so the fee structure is founded in that. High level, what those numbers are, it's a 70-30 split of equity with an 8% preferred return. And then our fees are on the low end of averages. So we take a 1% acquisition fee and a 1% asset management fee. And so other fees that were what we saw a disalignment of interest, things like construction management fees, disposition fees, those were all that we just left off of the table. Because as an investor, you have to ask the question, is it the right time to sell the asset because it's the right time to sell the asset, or is it the right time to sell the asset because the sponsor is getting a 1 to 3% disposition fee? So if there was ever any kind of question like that, we just removed that from our fee structure to keep the alignment of interest very simple, very straightforward. And so no waterfalls, no complex structures that are hard to calculate, just 70-30 split with an 8% pref.
Got it. Simple and easy to understand. I'm going to kind of jump into a little bit. What exactly are we doing when we're looking at new deals, and what kind of returns are we typically looking to hit?
Yeah, that number's moved over the years,
Yeah.
right? So like as market conditions become more competitive, sometimes are we're getting that compressed. But where we're at right now is a 10% average cash on cash return, excluding the sales proceeds, because our business model is mostly focused on long term hold, 10-year holds typically. A lot of times projecting out 10 years into the future, the investors are not that interested in what we're projecting on the sale, but we're more focused on that operational cash flow. So 10% cash on cash return, excluding the sale. And then IRRs are usually going to be between like 12, 13, something like that. Depending on the speed of which we can add that value, the IRRs might go a little bit higher. Historically, we have exceeded those returns, but we've also had very favorable market conditions for many years. And so I think to create a realistic expectation of what we're underwriting to today, being that we're at the tail end of 2024, is we're targeting 10% or more cash on cash returns and 12% or more IRRs on a long-term hold strategy.
You just briefly hit on being in a favorable market for a long time. Could you kind of dig into a little bit where you see SNS heading in a much different market today than when we started out?
Yeah, and I want to clarify, like when I say market, I mean like the macroeconomic conditions, not necessarily Cincinnati, Ohio. And so I think that from 2010 to maybe 2011 to 2022, we were in a very favorable market conditions for most real estate investors and most syndication sponsors. It was hard to not be successful during that time.
Yeah.
And I was always aware of that and always being conscious of like, we need to build the foundation that will support us in the more challenging times. And it's been nice to have this little bit of a blip from 2022 to 2024 where other people were challenged and we got to show off what we had been building for a little bit.
Yeah.
Moving forward, I don't have a crystal ball. I don't know exactly what will come of it, but I think what I'm really proud of is SNS is great at rolling with the punches. Good at, when we say we're good at operations, we're good at adjusting to those macroeconomic conditions. And in my very biased opinion, it's when we are great at operations and we have the market, the Cincinnati, Ohio market that aligns with our investment philosophy of consistent, predictable cash flow, aligning all of those things makes us very recession resistant. And so whatever those future conditions look like, I'm confident that we will navigate through them really well.
And I'm going to kind of switch over to the investor side of things a little bit. You mentioned being in the business for a good amount of time now. I'd like to understand what percentage of investors have reinvested with SNS. So they've done one deal, they've liked what they've seen, and they've brought money back in.
Yeah, so that number is about 60%, or 60% is the number. And I'd like to expand on that by saying like our entire marketing strategy for building relationships with investors is word of mouth. So our focus is on operations and forcing the appreciation. And so our nose has been against the grindstone on working and being that active partner that our passive partners are partnering with. And so we're not out there doing a ton of sales and marketing and attracting investors. And so we rely heavily on that word of mouth. We rely heavily on producing good results. And I believe that 60% number is a reflection of like, we have produced those good results. People are returning to invest multiple times. So I know that 60% is investors who have participated more than once, but there are a large majority of those that have participated more than twice, right? And so I don't know that exact number, but we're really fortunate to have a really loyal investor base that's participated in a lot of investments with us.
Yeah. You talked about exceeding expectations in previous deals. One thing that I think would be important to point out is in that case that the property overperforms, are the LPs capped or are they going to participate in that overage there?
Yeah, so we share in that upside. So going back to the fee structure question and mentioning like there's not a lot of bells and whistles and complex waterfalls.
Yeah.
It's a 70-30 split.
Okay.
And that means like when we do really well, the investors do really well. There's no dilution of that says, hey, we did better than we thought, so we should get more than we originally said. No, It's just the fee structure stays the same regardless of the IRR, regardless of the success of the investment.
Mm-hmm. And have we had any deals that have underperformed? And if that's the case, what have we done to correct that? And how has SNS tackled that in the past?
Yeah, so we're really good at understanding our business model will not always go to plan,
Mm-hmm.
and then making the adjustments along that long-term hold
Yeah.
to get us back on track. And so I would say none of the business models have always gone exactly to plan,
Mm-hmm.
but there are a few where, well, let me take a step back and say we're really fortunate to have never had to do a capital call. We've never had to pause distributions, but there are some where I would say we're less than 100 basis points off of our original projections, so less than our original projections from an annualized cash on cash perspective.
Yeah.
And we could attribute that to changes in expenses like property insurance and taxes. But at the end of the day, it's our responsibility to say that expense went up. How do we offset it?
Mm-hmm.
And some of those we're just working through now. But to have our portfolio as a whole by far exceeding our projections, and a few deals just 100 basis points or less off of our projections on annualized cash on cash return, really happy with that result. And I hope we can continue that type of reputation.
Yeah. Yeah. And kind of building off of those returns and what investors should be looking at. There's one term in particular that I heard on a recent podcast that I think will be important to discuss here, and that's exit cap rate. I want to understand the significance of that term in the context of multifamily syndications.
Yeah, I think where we've built a lot of reputation with our investors is how we underwrite deals,
Mm-hmm.
and there's lots of levers that can be pulled when underwriting deals, as you know, Steve.
Yeah.
And one big one that I think can be pulled either in a conservative direction or a non-conservative direction is the exit cap rate. And as a limited partner, it's very hard to verify should this specific asset be a 5 cap or a 7 cap or a 6 cap. And the difference between 5, 6, or 7 on your exit cap rate in your underwriting can have significant impact on your returns. And so where we've built that positive reputation with our investors
Mm-hmm.
is being conservative or realistic with our exit cap rates. And I think what this comes back to is like we spent the first 8 years learning how to underwrite, learning how to build our business with our own capital.
Yeah.
And so we weren't getting super aggressive just to make deals work because we were the beneficiary of being conservative, or we were the ones who paid the price for being overly aggressive.
Mm-hmm.
And that's translated into our business today with that same approach. And so you'll see us underwriting where we'll, on a 10-year hold, we'll put 100 plus basis point cap rate decompression on the deal that we're buying because we know the asset will be less desirable 10 years from now than it is when we're buying it.
Mm-hmm.
Where, as many of the investors watching this will know, like there's too many sponsors that are moving that cap rate in the opposite direction, where they buy at a 6 cap and they say they'll sell at a 5, and it's like real estate ages and it becomes less desirable, and you need to reflect that in your cap rate.
Absolutely. I'm going to pivot now a little bit into risk management and due diligence. The first question I want to hit on here is a fun one. How do you handle key person risk, death or breakup of the partnership? Is there a succession plan in place? Could you just dig into that briefly?
Yeah. So talk about all the ways I could die.
Yeah, I guess. Yeah.
No, it's a really
one.
important question because at the end of the day, the limited partners are entrusting us with their investment. And if they're entrusting me and only me,
Mm-hmm.
you have to ask the question like, well, what happens when there is no me?
Right.
The good news is like SNS Capital Group and SNS Management as a company, we're now at 64 team members, and there are 3 general partners, being myself, my COO Andy, who's my brother, and then our CFO Coleman. We are the 3 general partners.
Mm-hmm.
And so there's not just one key member, but something we've put in place just to be proactive about if something were to happen
Mm-hmm.
is each of those 3 key members have a $10 million life insurance policy
Mm-hmm.
that is owned by SNS Capital Group.
Yeah.
And what happens is if one of us were to pass away unexpectedly, obviously that life insurance policy gets triggered. That gives a significant amount of funds to the company to then hire the staff and make the moves needed to make sure we don't skip a beat.
Yeah.
And so there are, I still wear a lot of hats. I'm very active in the business.
Mm-hmm.
And so it would take a significant amount of effort to if I were to get hit by the bus, metaphorically, to move quick enough. But there would be the capital there to back that up and support those moves necessary. So we've thought through all of that, and I think that's an important question for limited partners to understand. If you're going to entrust someone, what happens, if that unexpected event happens.
Yeah, and I think it's important to point out how much trust these investors are giving to SNS. I think you've brought up a good point about the way we look at a $50,000 investment, which is the minimum investment at SNS. Can you kind of just touch on the way we view how important that relationship is here?
Yeah,
And that trust.
I think you're referring back to kind of like how when you started at the company, just explaining to you what it means to raise capital.
Yeah.
And in the industry, I think this gets missed too often. So, too often syndication sponsors are just looking at their limited partners as a bank account or a check into the deal.
Yeah.
And what I've always reminded myself and structured our company this way, and when bringing you on, had made it very clear, is investors trade a portion of their life to earn the capital that they're entrusting us. So whether it's $50,000 or $5 million, or whether their net worth is $1 billion or $1 million, it doesn't matter. They traded a portion of their life, their time, and to earn that capital to then entrust with us. And so you think about, as a society, what lengths we'll go to protect a person's life or extend it even a day or two. And yet, as an industry, we will raise hundreds of thousands of dollars that people traded large portions of their life for, and approach it somewhat recklessly. And so I think as a company, we hold that capital to that standard. You traded a portion of your life to earn that capital. We'll hold it as sacred as we would a portion of a person's life. And so I think that could be viewed as like fluffy, but it really is part of our culture and our organization to make sure we're making wise investment decisions and being a good steward of our investors' capital.
Yeah, I think that was just an important point on the topic of risk management. I'm going to kind of switch back into due diligence. So my first question there is, what exactly does the due diligence process look like here at SNS?
Are you saying for acquiring new deals or investors?
New acquisitions?
Okay.
Yeah.
So we rely a lot on our expertise in the market. And so again, we are only in one market, Cincinnati, Ohio. So we know this market like the back of our hand. We're born and raised here. We built up our company here. And so our due diligence on assets is heavily weighted on the fact that we have that background in property management. We know this market really well. And then we have our background in construction. And so one way that gives us competitive advantage is being able to sometimes target a vintage that produces higher returns, but doing it with a bit of risk mitigation, meaning like 1970s, 1980s assets that maybe some sponsors will shy away from. We're able to go into the due diligence process of those types of assets, really understand the vintage and de-risk the deal because of our experience in those assets in this specific market.
And when we're doing the underwriting and all the due diligence for these properties, can you walk me through the stress tests that we do on these as well? I think that's important to bring up.
Yeah, it goes back to the first 8 years when we were doing this. It was all with our own funds. So stress testing, when we're underwriting, we're really pushing the envelope to say what bad things could happen here, and will this investment be able to sustain those? What's the probability of those happening? And feedback I've gotten from our limited partners over the years is in our offering memorandum, we provide several stress tests to show, if our rents miss projections, what will the returns be? If we can't refinance, what will the returns be? If interest rates move this way, what will the returns be? So those are some examples of stress tests. I think in our offering memorandum, we usually put like 5 to 6 of like the most common ones. And I think it's really helpful for investors to wrap their head around how we're assessing the risk and stress testing. But internally, we're doing far more stress tests than just 5 to 6, right? So we're running lots of different scenarios to know, if this goes wrong, what will the returns be? And are we comfortable with that based on the probability of thinking that of how likely that is to happen?
Yeah. And the reason I brought that up was I remember when Jared was teaching me how he does this. I remember just my mind was kind of blown how many different scenarios he looks through in the team here. So I think that's something for an investor. I'm putting myself in your shoes. I would like to hear that. So now I'm going to kind of jump forward to financing and the overall debt structure of our deals. Can you just walk me through how SNS typically approaches this for our new acquisitions and existing ones?
Yeah, yeah. Debt is a huge and important part of the overall business strategy and real estate investment. And so, great question. But I would take a step back and say that SNS only raises capital on a deal by deal basis. So we don't do funds. And so all of the business model and the debt structuring would be outlined in an offering memorandum to the investor prior to them making the decision do they want to invest or not. So our debt is appropriately structured to the specific acquisition and business model tied to that acquisition.
Okay.
In general, we're usually favoring long-term fixed rate debt that is structured in a way that we can add a debt restructuring. So an example of this would be we would buy a deal that has value add upside. But when we're buying it, it's producing enough cash flow to support a agency debt long-term 10-year fixed rate loan. But it gives us the ability to add a supplemental loan in say year 2 or 3 or whenever we have forced that appreciation. And so we typically lean towards long-term fixed rate debt. And sitting here at the end of 2024, I can say that was a very, in hindsight, that was a very wise move that we did for many years prior to interest rates going up. So one of the reasons that we've had such strong results in the prior 2 years is because we've focused for many years on doing long-term fixed rate debt. So we were not impacted by the big swing in interest rates over from 2022 to 2024. So it's going to depend on the specific deal. We have taken we've used swap loans and other types of loans, but we're going to target the debt structure that aligns with the business model. I think that's what a lot of sponsors got in trouble with is they didn't align their debt structure with their business model. And we'll do that every time and outline it in the OM.
And on these loans that SNS is taking on, who's going to guarantee that loan?
So some of them have personal guarantees. Usually it's a limited recourse. And then the majority of them are non-recourse loans like through Freddie Mac, Fannie Mae, or sometimes some life insurance companies. But they do require us to sign on those loan documents and have the net worth and liquidity available to qualify for them. And so myself and my 2 other partners, Andy and Coleman, were the ones signing on those loan documents. And even if there is a personal guarantee, we would be the ones signing this.
You touched on interest rates. I think right now we're recording this in early October of 2024. Rates have recently dropped slightly. Can you kind of just walk me through how SNS is looking at that and what kind of outlook we have for the coming year?
So the outlook we have for the coming years, we do think that we'll see more transaction volume. And so 2025, we think that in our market, there was a lot of other investors and owners like us that had long-term fixed rate debt. The Midwest typically caters to a more conservative investor. It typically has stronger cash flow. And because of that, more of us were able to put fixed rate loans on our property. And so we're not seeing the same distress that you might see in the Sun Belt when it came to a lot more bridge loans. And what happened is over the past few years, because so many investors had that long-term fixed rate debt, we kind of just went back onto the back burner and said, like, we're just going to hold, operate, and wait this thing out. And now that we're getting the indication from the Fed and we're seeing rates, the market is, believing that rates will continue to come down. Even just that sentiment is starting to increase transaction volume. I don't know if it will continue or what's in the future, but we do think that some of those people that were on the back burner, sitting on the sideline, that are wanting to generate some sales proceeds will come back to the market and start to transact. Did that answer your question fully?
It did, yeah. Okay. I'm going to kind of go a little bit back to talking about the loans that we're taking on these properties. In the event that if we sell the asset as planned around that year 10 timeline, is there any kind of prepayment penalty typically on those? And is that included in the cost of the sale? And how does that impact the return that the investors get?
Yeah, the prepayment penalty is usually going to be associated with the debt, and it's going to depend on the debt that we took for that specific asset, or the debt that's on that asset at the time of the exit. Because sometimes we might have a refinance partially through the hold period, and then we have a new loan. Typically, our exits are going to be lined up with the debt to avoid those prepayment penalties. But if there were favorable market conditions, let's say we had a 10-year loan and we saw favorable market conditions at year 8 and we wanted to make the exit happen and capture that upside, we would just simply be adding in that prepayment penalty into our calculations. And a lot of times the way we approach that is from a net present value calculation. So we're doing the math to say, would it be better to take that money today with the prepayment penalty, or should we wait and get this projected return on exit at year 10 with a little bit of unknown, and then the net present value, which one is more, right? So that's how we approach those decisions, and we do the same thing with refinances, right? We're saying, should we hold the existing loan, or should we take on a new loan? And a lot of that comes down to just net present value calculations to decide should we or shouldn't we.
Yeah. Well, great. I think we touched pretty heavily on financing, risk management. I want to kind of pivot over to distributions. I'm sure investors are wondering, how often do we do that, and how soon can we typically see those first distributions going out on a new deal?
Yeah. So I want to answer the distributions question, but when you just said, we touched on risk management and all that stuff, and I thought back to your question of debt and like who's the personal guarantee, which that makes me think like skin in the game, right? So like myself and business partners Andy and Coleman were the ones signing on those loans. That indicates some skin in the game, but a question that I think we missed that I think a lot of investors would want to know is the other big component of skin in the game, which is like investing into the deals ourselves. And so I don't want to skim over your question on distributions, but taking a step back and just saying, like, from a risk mitigation standpoint and comfortability of an investor investing with SNS. One thing I think that's really a differentiator of SNS is our core competency is that we are, no, I shouldn't say our core competency. First and foremost, we are owner operators of multifamily assets. And secondly, we happen to use syndication to further that. And so with that distinction, I think it's really important to say, like, we are investing heavily into these deals. And so the skin in the game question, like, how much of your own money do you have on this deal? We'd be happy to answer that on a deal by deal basis. But a lot of times it's significantly more than the industry standard because we only focus in one market. We don't do as many deals as most syndication sponsors because they're just fewer and farther between. We also spent the first 8 years of our career not raising capital, which in result has made our cash position pretty strong throughout the years. And so we're contributing heavily to where a lot of times, you know, myself or my partners are the largest LP investor in on the deal as well. And so one more distinction is sometimes the general partners will kick in money into the deals as the general partner. And one thing we do differently is that we actually personally put in our capital as limited partners. So the terms of the terms of the agreement are identical to our limited partners. So maybe that's called Class A shares, and Class B shares would be the general partners. So SNS Capital Group is the general partner getting the Class B shares, but you know, Jared Sturm and my wife are participating as LPs, putting our own personal capital in and signing the same exact documents that all of our LPs are signing. So that goes back to that alignment of interest. I think that's a huge part of risk mitigation, and just wanted to highlight that before we move on to distributions. So, so now shifting into that next section, you kind of, I believe you asked, like, when do we do distributions? Could you re-ask me that just to help?
Yeah, I'm just curious, when we have a new acquisition, how soon can investors expect getting that first distribution, and how often do those typically come out from then on?
Okay.
Mhm.
So we do quarterly distributions. And one thing that we've received great feedback from our investors on is that we do them like clockwork. So we will send our distributions and quarterly reporting 30 days after the calendar quarter ends, and that's every single calendar quarter. Now, on that first one, typically what we do is we'll outline in the offering memorandum, here's when you can expect your first reporting and distribution cycle.
Mhm.
Oftentimes what we say is it's the first full calendar quarter after the acquisition. So meaning if we, bought on a specific day and the calendar quarter ended
Mhm.
15 days later, there's not really a need for us to produce a distribution and report.
Yeah.
But if it's 2, maybe 3 months, we'll just go ahead and start that. I think a big part of it, that I should highlight here is that typically we're buying assets that already are producing cash flow.
Yeah.
And then we're enhancing that cash flow.
Mhm.
And so a lot of times our investments produce distributions from the first full quarter of operations.
Mhm.
And so I think it's a big win when you contrast us against other organizations or even other investment strategies like ground up development or things like that, where it's not a cash flow driven investment strategy.
Mhm.
So we're typically the first full calendar quarter after acquisitions, we're producing reports, producing distributions, and then every quarter on the calendar quarter after that.
Mhm. Good. I'm glad that we hit on that. How often will investors be receiving updates? What exactly does that process look like? I know sometimes there are limited partners who feel like they're left in the dark about the progress of what's going on. How is SNS looking to be proactive about that? And can you expand on that?
Yeah, I think communication is a huge responsibility of a general partner. We go back to the comments of like how we view investor capital and how important that is. Like it's a responsibility when borrowing it to keep people informed.
Mhm.
Now I'll highlight one of my business partner, Coleman. His background prior to joining SNS and founding SNS is like he did investor reporting for a multi-billion-dollar real estate firm called Phillips Edison here in our Cincinnati, Ohio market. And so he brings that institutional grade background to reporting. So we have very clear professional reports. But what he has done so exceptionally well is make them extremely understandable. So we've gotten great feedback on it's not just a bunch of stuff we can't understand, a bunch of spreadsheets that we don't understand. He condenses that into a very digestible narrative. So the cadence of those formal reports that he puts together and really leans on his experience at the institutional level, that's quarterly.
Okay.
So financial reports, a narrative of what's going good, what's going bad, how are we reacting, how are we pivoting our business model, all of that's quarterly basis. But when we first make an acquisition, we know that it can feel like a long time to wait 3 months before hearing anything. So we'll do 30-day update, 60-day update, and then typically the quarterly reporting starts to kick in then. We're also good about saying it doesn't always have to follow a consistent cadence. If something happens at the property or if something is changing, we should just reach out and let people know. And so I'd say that that's the cadence, but also we're open to being flexible and just having good communication. I think as a smaller firm, we still have that flexibility and we're really good at implementing that.
Yeah. And I know that in my time here, we've actually had investors that have flown out to Cincinnati where all of our portfolio is based, and we have an open door policy. So could you kind of just touch on that a little bit and how that looks?
Yeah. Going back to like how important that capital is, like I see it as from a due diligence standpoint, from an investor assessing SNS, like there is no wrong question. There is nothing that you can ask that would not be appropriate because it is a high amount of capital that you traded a lot of time to earn. And so whatever you need to be comfortable with making that partnership, I feel is justified. So yes, we have open door policy. We have people come out. it's really easy for us to tour people around to our 19 communities and show the portfolio because they're so geographically focused. So a lot of times people come in, see the corporate office, meet some of the team, go out to the property, and just gives a ability to gain some confidence in all the positive things we're saying, but then you actually get to see the tangible asset and be comfortable.
And with having a solid investor base built up, one important thing that I think we hear a lot is, can I have a referral? Can you talk about how exactly we try to customize that process for potential LPs?
Yeah, and this might just be like more generalized advice. You can do this to SNS, but you could also do this to other sponsors as an investor. Is like, just like with anything, if you ask for a reference, you're probably going to get the most, catered reference to make sure that the response is what the person providing that reference wants them to say. And so what we always say is like, we have enough investors that typically we can give you a reference in your specific geographic area. So then you could potentially even meet in person if you're comfortable with that. But for example, let's say you live in LA or New York or whatever, and you say, I want a reference or two or three that has participated with SNS in 2 or more deals, and I want them in this specific area. And that's going to force the sponsor to provide you with a less catered reference and just give you a more realistic interpretation of how they're producing results for the average investor. So we like doing that, and then it helps them form relationships. They can share notes, learn from each other, and just kind of build that organic network of our investors.
And are you willing to give out previous OMs as a way to review SNS?
Yeah. We have all of our historical offering memorandums for all the deals that we've put together and currently own, and we share those with investors. We can share as few or as many as you'd like, and I even have people who are doing due diligence on us say, send me the OM from a deal 5 years ago, and then send me the most recent investor report, which we have to redact, like, people's names, but we can then show, like, here's what we projected and here's what we're actually producing 5 years later. And I think that's a great approach to kind of validate how conservative are you in the OM, right?
All right. Well, I think those are some good questions for the investor relations side of things. I want to start to dig into probably one of the most important topics, which I think taxes are. So the first thing I want to hit on is K1s. When exactly is SNS delivering those? And you know what? I'm going to let you answer that, and then I'll move forward.
Okay. So I think prior 3 years, we've been able to deliver all K1s before March 15th of the following year. And so that's our goal every single year. We do partner with a CPA and tax preparer to prepare all the tax returns for each individual LLC that owns the assets that the syndication is. And the good news is we have a really great relationship with that tax preparer. Actually is invested in several deals with us. And so he's great about making sure we're one of the first sponsors in our LP's portfolio to be able to provide them that K1. Some people that's extremely important. Some people it's not as important. But at the end of the day, we want to make sure that they're not waiting on us.
Exactly. And can you, I know that you're not a tax professional. There's obviously a disclaimer on this, but can you just walk me through high level, what are the main benefits of investing as an LP in these deals? For a tax standpoint.
I think most of the people that are watching this will be attracted to real estate investment for multiple reasons, but one big one is going to be the tax advantages that real estate investment provides. And so I hope that the listener understands that, what tax benefits they would receive from things like depreciation. And what I think I can clarify is if an investor was to go out and buy a single family home for a rental, right? Buy a single family rental that no syndication, nothing like that. All the tax benefits that they receive in doing that strategy would flow through to them very similarly as a passive investor in a syndication. Because at the end of the day, if you're investing in a syndication, you are a owner of the entity that owns the real estate, and the tax law will have that flow back to you through the K-1, including the depreciation and the tax benefits.
Yeah.
And so one thing that our investors really appreciate is, Coleman, my business partner, our CFO, he's a CPA himself. He has his master's degree in accounting, and he's very good about maximizing the tax benefits of each of those investments.
Yeah.
And passing that back to our investors. So not to get too into the weeds, but we're maximizing depreciation through bonus depreciation, cost segregations, and pushing that all back to our investors so they can have a good tax strategy off of this investment.
You mentioned cost segregation. What exactly is that?
So the IRS gives real estate investors the benefit of saying that this asset that we own will fall apart. And so we can create what's called a phantom expense by reducing our taxable income. So we're saying, the roof is going to deteriorate, the carpet's going to fall apart, and ultimately the way the tax code is written is like the building is going to be worthless. In residential real estate, it's 27 and a half years. That's their terms. And cost segregation lets us accelerate that schedule by breaking out the components of the property. So rather than say we bought the property for $10 million, we take the $10 million simplistically here, divide it by 27 and a half, and provide that much depreciation. What we do is we break out the components. So we'll say the carpet is worth X, the outlets and switches are worth Y, the roof is worth Z, and an engineer and a CPA are going through to identify all those components of the properties, break them out, and then we can classify those per the IRS rules to say the carpet is 5-year depreciation schedule rather than a 27 and a half, which pushes more depreciation into the earlier years and maximizes the tax benefits that we then pass back through that K-1.
Yeah, taxes are a fun topic. I'm glad that we hit on those. I hope that was helpful to the potential investor out there. I'm going to transition now into our acquisition process here at SNS. I want to learn from you, how exactly are we going out and sourcing new acquisitions? Because we do get a lot of questions about this. And I know you touched on us getting more excited about 2025. How exactly are we finding new deals today?
Yeah, I mean, the bottleneck in our company is and has been quality deal flow. But I think the reason for that is because we are still so geographically focused. So contrasting us to other syndication sponsors, you might have someone that's across the whole Midwest or across the whole U.S. We're in the greater Cincinnati, Ohio market. There's about 70,000 multifamily units in our market. So there's only so many, and there are only so many transactions. And so positioning ourselves to acquire those is really important, that we do it any and every way possible. And so historically, about half of our deals are off-market direct to owner. And then the other half is through a real estate broker. And some of those could be designated as fully marketed. Some of them could be designated as, off market through a broker. But what we lean on is this competitive advantage of being very focused in one market. And that allows us to maximize relationships. That could be relationships with owners. That could be relationships with brokers. But as you can imagine, if you had to do that across a whole Midwest, Southeast, a whole region, or across the whole U.S., it would be impossible. But we know all of the brokers in our market. We know a lot of the owners in our market. We're building those long-term relationships. So when those opportunities that are fewer and farther between come up, we're best positioned to execute on them. So it's challenging. It is the bottleneck, but we're continuing to source quality acquisitions.
Yeah, great. And I think it is important to point out risk with this actual investment. I probably am circling back a little bit to what we were talking about earlier. But when someone's putting $50,000 into one of these deals, what kind of risk do they have with that money? Can they lose all of it? Can more than that be taken from them? Can you kind of just expand on that a little bit?
Yeah. So in the term limited partner, a lot of that word limited is that your risk is limited to the investment that is being made. Right? So you are not able to be sued for something that happened at the property. If you invest $100,000, the maximum that you can lose is $100,000.
Yeah.
And so that is a real risk that investors have to weigh, is like, what's the probability of that happening? But it is limited to that. And so I think that's really important distinction when contrasting it to, say, more of an active real estate investment and making that decision. And so if you go out and buy that single family rental, and depending on how you structure it, something happens to your resident, what else is at risk? And so limited partnership limits your risk to your equity contribution into that structure.
Okay, great. Thanks for that explanation. And when we're underwriting these deals or looking at new acquisitions, can you walk through and kind of just go in depth on what exactly does our renovation budget look like, and what is it based off of? Is it based off of a contractor bid? Is it just a wild guess, or is it from your own experience? Can you kind of just walk through that a little bit?
Yeah, and this is really part of our competitive advantage. And so being vertically integrated is not just for us having our own property management firm, it's also having our own construction arm of our company.
Yeah.
And so the underwriting and the bid process is all internal. And a lot of it is based off of historical data that we've already done, right?
Yeah.
So we know, cost per square foot to install these specific material choices or specifications of how we renovate. Our portfolio is pretty bread and butter. Like, it's the same cabinets, the same flooring, the same paint, the same fixtures. And there's a reason for that. We negotiate pricing on those items.
Yeah.
We train our team on how to install those items at a very quick pace to keep labor costs down. So we have years and years and years of data and financials to help us anticipate what a future project might cost us to do. So we're not going out to contractors, like third-party contractors, and getting quotes. We're actually doing that all internal, and it's based off of lots and lots of experience doing very, very similar renovations.
Okay.
I think you mentioned cost. Like, typically, it's going to depend on the deal, but typically, like, we're between $10,000 and say $18,000 per unit on the interior renovations.
Yeah.
And then each acquisition is going to depend on what we plan to do for other CapEx projects, right? If it needs parking lots and roofs, we'll go out to vendors to get that quoted. And we have great relationships in the market to do that. That's going to change the price per unit in total renovations significantly than if we were to buy an asset that needs the interiors updated, but the parking lots and the roofs are in great condition. So I would answer that by typically like $10,000 to $18,000. And I think a lot of investors are really happy with the end result we're able to produce with $10,000 to $18,000 because everything's in house and we handle that internally with our own employees.
Yeah, I think we could go on and on all day about operations. I think that really is one of the most important core competencies of SNS. And I think there's one story that I want you to share that when I started at SNS, I thought this was really neat. It was what Andy did with ordering from Home Depot I think it was Gatorades and Red Bull. Can you kind of just share that story? I think that'll be a fun one.
Yeah, I think that it's a story that I guess the lessons of it highlight how methodical we've gotten about systems and processes within our operations. And before I share the story, what I'll tell the audience and investors is, a lot of times investors are attracted to real estate syndications or real estate investment in general because of the financial returns that it can produce.
Yeah.
But what is so obvious when you look at who is producing financial returns over a long period of time successfully is that financial returns in real estate are supported by the on-site operations, and on-site operations are supported by the systems, processes, and people who work there.
Yeah.
And so we've spent many, many years polishing our processes, hiring the right people, building those systems.
Yeah.
And so back to your story, when it comes to renovations and apartment turnovers, we have a very defined process that, something we're really proud of is those $10,000 to $18,000 renovations take us on average 2.5 days to execute. So we have turn teams internally, employees that are teams of 4 They go in, they do the full gut, they do the renovations to install new flooring, cabinets, light fixtures, outlets, bathrooms, all that stuff. That's taking us about 2.5 days. And my brother, who's our COO and is methodical about how we build systems and processes, he was assessing our processes when it comes to renovations. He goes on site, looks at the apartment community that's being renovated, walking around, kind of watching our turn teams work to look for inefficiencies or opportunities there. And he notices on the kitchen counter, it's a couple bottles of Gatorade, some Red Bull cans, and he asked, the turn team lead there, like, where do you guys get those? And they're like, oh, up at the gas station at the corner, right? And to highlight his mind and how we approach even the smallest nuances of operations to get more efficient to support those financial returns, he then says, like, in his mind, he's calculating, okay, well, how much are we paying in labor per hour? How much increased vacancy does that create for when those technicians leave the property, drive up there, when they're gone, whoever drove has the vehicle that has the tool that the other guy needs back at the property. So we're thinking about all of that. And what he ended up deciding is when our project managers are producing the material order that shows up on pallets in front of the apartment community on the day that our turnover technicians are there to start, we just, from Home Depot, put a box of Red Bull and a carton of Gatorade on the top. It's wrapped in saran wrap. The whole thing's there. And it helps with our retention of our employees because they're like, man, this is great. Like, I get the drinks that I like. And we're thinking it's great because, one, they're caffeinated and ready to go. And two, we don't have those slight inefficiencies. And so I think it's just one example of many where over 16 years, we were just looking for inefficiencies and cleaning them up, and kind of highlights our organic growth and how we're just always looking to continuously improve and polish and polish and polish. And that's why a lot of times when we say financial returns are supported by operations, that's why our financial returns have been so strong, is because we've been focused on operations. And that's just one story of that.
So focusing on those efficiencies, the last thing I want to hit on for the asset management side of things and operations is, can you just briefly share a few KPIs that we're tracking and kind of where SNS is standing right now?
Yeah, I'm glad you asked that. It's not a question that typically comes up in the conversations between LPs. And I think that's a mistake because LPs will focus so heavily on track record and more of let me say, like, going back to that statement of, if financial returns are supported by operations, and operations are the result of the people, systems, and processes that are in place at the on-site level, then isn't it important for you as an LP to assess, does your general partner have a good way of holding that team accountable to those systems, processes? And that's entrepreneurship, that's building a business, but that in our business, that's KPIs. Right. So key performance indicators at the on-site level that hold our team accountable to produce those efficient results that we're looking for, that trickle up into the financial returns. And so, each person in our organization, each role, I should say, will have 2 to 3 KPIs. We don't want more than that. And we won't go into every single role, but we'll start at kind of the entry level to help people understand what I'm trying to convey here is like a maintenance tech at a property, person who fixes things and repairs things. We're going to hold them accountable to 3 KPIs. And a lot of times our KPIs are structured on pillars of speed, quality, and quantity. And so for a maintenance tech, we're going to hold them accountable to how many work orders they're completing per day. We're going to hold them accountable to the length of time that work order is open. And then the final one on quality is we're going to hold them accountable to resident feedback surveys. So when they go in and complete that work order, every single one in our property management system will send that resident an email saying, rate them on a 1 to 5. And we'll be able to then get feedback from our residents, and we hold them accountable to getting a 4.5 or higher on average. So that's the maintenance tech. Leasing professional, we're tracking the number of days after the unit is available to be leased, how quickly they lease it. So we call it unit availability date. So the number of days past that when the next resident moves in, and our leasing team is averaging across our whole portfolio about 2.5 days from when the unit is ready to go and when the next resident moves in.
Sure.
So, and that's one that we hold them accountable to. We structure our commissions based on that. We monitor their renewal success rate, meaning that we hold them accountable to the KPI of like what percentage of renewals accept, and then we hold them accountable to their response rate for leads, being like phone calls and guest cards that come through online. Mm-hmm. So those are one examples, but I think the important part is like as an LP, you have to be thinking, I'm partnering with this group or this person because I want them to take on the active role of managing this investment. I want to be passive, so the other person should be active. And I think a huge component of being active is understanding the operations and holding the team accountable at an on-site level. Mm-hmm. So asking general partners a similar question to what you just did to me of like, what are the KPIs? How are you making sure that when things don't go to plan, you're monitoring it and adjusting and holding the team and the processes accountable to get the results we were chasing?
Yeah, and I originally had not anticipated asking that question, but it came to mind, and I think, like you said, it's really important to bring that up. I want to wrap this all up here pretty soon. The last thing I want to touch on, I know you briefly did earlier in the interview about the Cincinnati market and why exactly SNS has chosen that market as our place to grow. The first thing I want to talk about is, what does population growth look like in the area?
Yeah, I mean, population growth is something that every investor should be aware of when investing in real estate, especially long-term hold residential real estate, because if people are leaving, less demand. If people are coming, more demand.
Yeah.
Now, Cincinnati, Ohio is not known for its population growth. Certainly not. It's not the next Phoenix or, Dallas or whatever, Sunbelt market that's growing at a very rapid pace.
Yeah.
But what it has done well is have steady population growth. Mm-hmm. And so we're growing about like 1 to 3% per year every year for trailing 20 years, right? Yeah. So it's just humming along. And it makes me think of something I've said often is like, when I think back over my career in these 16 years of buying investment real estate in Cincinnati, the first 10, it was like Cincinnati was labeled as a stagnant market.
Yeah.
The Midwest is just boring. It's not growing fast enough. It's a stagnant market. And then the later years in my career, it's been labeled as a stable market, and really nothing has changed. Right? We're just chugging along at that same kind of growth, same kind of rent growth, same kind of population growth. The difference is what's happening in the other markets.
Yeah.
Right. So when the Sun Belt is shooting up, Ohio or Midwest is labeled stagnant, but when it's falling and we're still chugging along, we're labeled as stable. I'm okay with either, frankly, because what we're targeting is consistent, predictable cash flow, and the population growth caters to that. Rent growth caters to that, and the overall employment growth caters to that.
Yeah, and who are some of the large employers in the area, just for LPs that might not be aware?
Yeah, I mean, we have like well over 2 million population.
Yeah.
And so obviously that needs to be supported with lots of jobs. Mm-hmm. We have 6 Fortune 500 companies. We have a really diverse education base.
Yep.
And so we're bringing in, I think our population is 6 years younger than the U.S. population, because we have a lot of higher education here and favorable higher education. But then we also have the jobs to attract those college graduates out of those education bases into long-term careers.
Yeah.
So things like Procter & Gamble, General Electric, Fifth Third Bank, Kroger, those are some of our big employers.
Yep.
And then just a very diverse employment base beyond that, right? So it's not like we're niched into one thing: healthcare, tech, manufacturing. A lot of people think of the Rust Belt in the Midwest. They think like factories and manufacturing. That's certainly not what Cincinnati is. Maybe the middle of Ohio, but not into Cincinnati. And that's why we're continuing to grow and continuing to attract a younger and younger demographic. And so we have a majority renter base. But one thing that's, I would say, a stat that I'm even more aware of is the affordability in our market.
Yeah.
Right. So when we look at some of the struggles that these other regions are having, I think a lot of it comes back to affordability.
Yeah.
And so to put that into a metric, you would say what percent of your household income is paid in rent, and most of the markets are like knocking on 30%.
Yeah.
Right. So 30% of the household income is going out to housing. Or Cincinnati, our average rental rate is 17% of our average household income. So we're still a highly affordable market. And as an investor, that highlights how sustainable the long-term hold is, and even how much room there is for potential growth. Right. So if you're looking at a market and rents are 35% of household income, it simply cannot go up. Like, it's not a sustainable model, where Cincinnati is still extremely affordable. It's solving a national problem of affordability. And I think that is also playing into our modest population growth. It's a place where young people can come actually afford to live and have a good quality of life.
Yeah.
And to highlight that a little bit more, it's like, not a lot of our investors know Cincinnati extremely well, but to have 3 professional sports teams, the top rated zoo in the nation, and it just highlights things like, it's not like you're moving to the middle of nowhere to live affordably.
Yeah.
It's a good quality of life, which is helping fuel that population growth.
And Jared, we've hit on a ton here. I'm going to go ahead and start to wrap a bow on this. Is there anything that I didn't ask you today that you think would be important to bring up here? And I hit on a lot. So.
Yeah, no, I think you hit on a lot. And I think what I'm really excited about is, like, this will give us the opportunity to make the initial connection.
Yeah.
And as we said at the onset of the call, the objective is to then build the relationship further on more of a one-on-one basis. And so I don't have anything in particular to add, other than, like, if there is more that is top of mind for any investor, we're more than happy to continue the relationship and continue to dig in on specifics by having a one-on-one conversation.
All right. Well, if you stuck around this long, thank you for your time. We hope this video will be useful to you. Jared, thanks for taking all the time here today.
Yeah.
And you guys have a good rest of your day.
Thanks.